Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Ramsey, how are you?
Excellent. Always glad to be here.
Yeah, unfortunately, we lost our other two co-hosts to some pre-existing conflicts. So Mark and will definitely be back, and I know they wanted to be on this episode because we have a really interesting guest, Mr. Matt Carey, founder of Blueprint Income. But Ramsey, let me have you do a quick intro and set the discussion up.
Sure. So we're very fortunate today to have Matt join us. He has been an entrepreneur and an innovator in annuity distribution. He's also a Forbes contributor, and we thought it was just a great idea to have a chat with him about what brought him into this space where he thinks there's opportunity for innovation, and frankly how there's space for traditional innovators in this business, because the problem we're all trying to solve is actually an enormous one. We're trying to solve a problem for an entire country, and innovators like Matt have been, I think, an important part of what the future looks like. So with that, Matt, tell us a little bit about what led you to focusing on retirement and annuity specifically.
Sounds good. Hey, Ramsey, thank you for the intro, and Paul, good to see you. So I started Blueprint Income in 2014, and my path began a few years before that. So I was in the private sector doing mergers and acquisitions, young investment banker, and in 2010, the firm I was working for, Lazard, was contracted by the U.S. Treasury Department to advise on the re-IPO of General Motors. So, I think everyone, or most everyone, knows the story, but obviously 2008 went bankrupt, and the Treasury was the largest shareholder coming out of the bankruptcy. And, there was a big push to divest the assets that the government had assumed as part of TARP and as part of the broader bailouts. So worked on that. And the thing that I didn't know until working on it, two main things. One was just how little Wall Street analysts liked pensions. They really strongly disliked them. And there's a number of esoteric kind of reasons for that. But the main one is that, changes in the markets and changes in interest rates flow through a company's financial statements and can make earnings very volatile. And the second thing was just how much value there still was at the time of bankruptcy in General Motors' core business. It was the fact that their pension was underfunded by the tune of $35 to $40 billion. And that was the reason they had to declare bankruptcy. So one thing led to another. After advising on that, General Motors went public, and then about a year later, I ended up at the Treasury Department itself. And my portfolio was retirement. And so, the big revelation there was, just like analysts don't like pensions and employers don't really like pensions, and they're trying to get rid of them, they're incredibly valuable for individuals. And the difference, the way I like to talk about it is the difference between a pension of yesterday and a 401k of today is that a pension of yesterday required you to plan for 30 days until your next check came. The 401k of today requires you to plan for 30 years. And I think that's really hard for anyone, right? And so I'm kind of a pragmatist and a realist. I know we're not going back to the days of the defined benefit pension. But I thought, wow, shouldn't a 401k, shouldn't a 403b, shouldn't other types of retirement plans, shouldn't in the retail market, it be a lot easier to buy yourself a pension? So that led me to the annuity market. At the Treasury, I worked with a number of folks, including Mark Every, who was working closely on making it easier to access retirement income inside of 401k plans and in IRAs. and really just had this idea of, hey, if digital is going to be a really big part of how people access lifetime income. And I saw a very big gap in the market, sort of the promise of what a pension you buy for yourself could be, and what it actually looked like in the annuity market at that time. And so the divide, I guess you could say, between what it could be and what it was, I thought technology could be a huge part in filling that. So I ended up going to business school with the idea of starting the company, met my two co-founders there. And we launched the business in 2014, started selling policies in 2015, and have been kind of on the path ever since.
So what are some of the hurdles that you've run into, like both as a startup, but also in this particular business?
How much time do we have?
Top three.
You know, it's a really great question, and I think it luckily, I think, as an entrepreneur, you want that answer to always change, right? So like the hurdles I faced over the last 6 months are very different than the hurdles we faced in 2015. Maybe brief chronology. At the beginning, you know, the hurdle was, okay, I can see how this makes sense. And I can see how this will be the future, but a lot, whether they were investors or clients or whoever else, like, I'm not sure, like, I don't have an answer to the why now question. And frankly, I didn't have a great answer to that question either. You know, and the big thing that I had to convince myself of first was, are people really going to, you know, in this demographic, buy online through someone they've definitely never met in person and probably never spoken to over the phone, right? Like, it's a scalable business if you can convince people to do it, but, you know, annuities are sold, they're not bought. Annuities are sold over the kitchen counter. Annuities are the most important or financial decision a lot of people make. It's a large sum of money, all those sorts of things. So that was sort of the challenge at the beginning, you know, and it's evolved over time. I would say in the middle, it was really about, the biggest challenge was finding product market fit and really focusing really narrowly on the segment of clients that we wanted to serve. I think, again, going back to when we originally started the business, like, I had in my head, my co-founders also had in their heads, like, this should exist. So if we build it, you know, they will come and everyone should benefit from our service. And that's completely the wrong way to think about it. I think the right way to think about it is, who can you really delight? Like, who can you really deliver a experience that's so profoundly better than what they would have received elsewhere, such that they're going to go buy more, such that they're going to go talk about it with their friends, such that you have this very narrow segment of the market that you know how to serve really well, and then you can expand into adjacent markets over time. So really, like, trying to hone in on, like, who your target customer is, which to me felt like at the beginning, I'll be honest with you, like, kind of like something your marketing professor says, but like, why can't you serve, you know, lots of people? Like, it's online, it's better for lots of different folks. And that's
it's tough. And Matt, you know, I've enjoyed, you know, getting to know you. I think we connected in maybe 2015 or 2016. You know, kind of your journey, just only because, you know, our products kind of were in sort of same zone, and certainly I believe what you believe, which is you can connect. There's a way to connect with consumers. So if you look at that particular problem, you know, and I still hear it, you know, it's like, you got to have an agent pushing this stuff. They got to meet with somebody. I would say this pandemic has opens everybody's eyes, but I mean, really, is there an opportunity? I mean, are people buying annuities without, you know, seeing somebody show up in their house at this point?
Yeah. I mean, I think, you know, in droves, like, we'll do several hundred million of premium this year. It's a real business.
Yeah.
You know, it wasn't a large business at the beginning, and it takes time, but it's, you know, we've decided to focus on on sort of the simplest products that are available. So I can talk more about sort of how our product offerings have evolved, but in general, we offer income annuities and fixed rate annuities. So the income annuity is, very close to a pension, obviously. The fixed rate annuity is very close to a CD, without the FDIC insurance, and issued by an insurer rather than a bank. But those two products are our bread and butter. And, especially with the simple products, what we found is that demand is far greater during COVID than it's ever been, actually. And so I think, I have a view, I think the prevailing view of the annuity market over the last, let's call it 5 months since the onset of COVID, is demand is down. I don't think demand is down at all. We're in an environment where volatility's up and people feel like there's another shoe to drop around the corner. Yes, rates are low, but I do think that, we're demonstrating that the demand is really there. It's just a matter of making, for others, I think it's just a matter of making sure that you figure out a way to get in touch with a client in the way they want to be, interacting with you at the moment. So it's really interesting. I think the shift in how client interaction occurs, we were kind of doing it all the way from the beginning. But I think a lot of others are now seeing the value of Zoom calls, of, having a chat feature on your website, of, having a phone line that you're always going to answer, all those sorts of things. I think it's just a very different model that I think the current environment kind of necessitates, I guess.
So one of the things that's been interesting in sort of watching your arc is, you've tried out a lot of good ideas. Actually, I think all the things that, we've seen you do, actually, I think have been very interesting and good ideas. You started at one point, you started a personal pension product, which, seemed to be aimed at a bit of a younger demographic than maybe we sometimes see in this space. Very strong focus on income annuities. And then I guess sort of towards the end of 2018, you started focusing a lot more on MYGA. You're able to, a very nice comparison tool, very nice user interface on that. So it's been very interesting. As you've gone through that process, where do you think is without divulging any trade secrets, but where do you think is the sweet spot? Is it people that are sort of 55 or 60, or is there more of a market there for millennials than maybe we think?
Yeah, it's a great question. I think there's a couple of different sort of vectors. One is age, right? And maybe the other is product. You mentioned the personal pension. So the idea of the personal pension, it was to some extent about getting younger buyers in to the kind of annuity buying conversation. And it's been pretty successful at that. But more than anything, it was about not forcing people to make a bet on interest rates at a specific point in time. So without going too far into the weeds on income annuities, you are making a bet on rates inherently by buying an entire immediate annuity all at once when you retire, or even buying a longevity annuity, all at 65 to start at 80. You're making a bet on rates at that time. And so we thought that, just like dollar cost averaging, contributing every 2 weeks to your 401k, that sort of caught on. That idea of just small amounts over time yield to big things once you get to retirement. That was sort of the idea of the personal pension. That was the driving force of it. We found that did get some people more comfortable, but I still think the biggest challenge around the income annuity is the illiquidity of it. And the illiquidity of the income annuity is kind of inherent in the product, because you can't pool mortality risk if you let people out, because you have adverse selection where sick people leave, healthy people stay, insurer doesn't do well enough, there's no benefit of pooling your mortality. So that's been something that the challenge of overcoming the bias towards liquidity on the part of consumers is really, really a big challenge. And I think we are, when I say we, I mean people working on this problem, both of you, as in the market writ large, the BlackRocks of the world too. We're very early innings in figuring that out. And I don't think anyone's frankly found that sweet spot between makes sense for the insurer from a capital perspective, makes sense for the individual from a value perspective, and really drives down the cost of retirement and drives up the certainty of it. So I think from a like, it's really working, it's really humming. I think on the income side, like we're not there yet. And I don't frankly know anyone who is. And so I think, but that's, I think, the golden ticket, right? Like going back to why we started the company, it was all about like, shouldn't you make it really easy to buy yourself a pension? And so I think there's a huge opportunity there. But I think my mentality is, and I always try to take a beginner's mindset to hard problems. And I'm, every day I wake up, think about, okay, like, what am I missing here? Like, how do we really fix that?
Yeah, it's different. It seems like it's a huge opportunity, right? You're young, you buy term life insurance. Why would you not buy a little bit of a pension and separate yourself from the market? But I agree with you, Matt. And I see it with the older demographics is, you start talking to a 65 or 70-year-old and, frankly, Ramsey laughs when he sees it because he knows he's done the same thing. Is I'm explaining the difference between simple interest and compound interest to 65-year-old, and I've actually had people tell me I should go back to math school because I'm not doing a good job. So when you flip down to that younger demographic, okay, you've got kids, 25 to 30, 35, saddled with enormous amounts of college debt, right? They're sort of in the pay down debt. How do you kind of make the leap? Now, does the Secure Act open up opportunities where you get the fiduciaries off the hook and maybe they're the customer where instead of doing just the 4% match, they're doing like a 3.25% and they're buying a little bit of an independent pension for me? I mean, does that open up new avenues into that younger demographic?
Yeah, I do think it does. I think, academics love income annuities. People who come to the market kind of fresh love income annuities because it's the annuity, to be honest with you. And it's arguably, but I would defend it. It's the best diversifying asset inside of a portfolio. It's not the best asset for 100% of your money, but it's the best diversifying annuity inside of a otherwise well-diversified portfolio. I think the challenge is just getting people to kind of like, you were talking about simple versus compound. Like, how do you get people to value the income, right? And so on the one hand, people are like, I love my pension. It's the greatest thing ever. I wish my kids had it. I'm so bummed that they don't. But those same people, they don't know, they can't tell you what the present value of those future cash flows is, right? Like, investment bankers can do that. Like, your average person can't and shouldn't be asked to. And so it's a really hard problem to like have people actually understand it, right? Like, you guys may know the numbers. I don't know them exactly, but like the average Social Security benefit is something like the present value of it is something like $300 to $700.
Yeah, the numbers are huge.
People do not understand that's the size of that asset.
And the sad thing is, if you went around and asked a bunch of 65-year-olds, hey, I'm going to buy your Social Security for $100,000. I don't know what the number is that would take that, but a lot would. A lot would, which is really sad, right? It's really sad. And so, I think, it's a hard problem to solve. Like, a lot of it has to do with consumer education and kind of like overcoming that hurdle. But going back to like what you were saying, yeah, I do think the Secure Act is a key piece. I think income annuities are eating vegetables. We should all do it. Kids don't do it unless their parents, make them. I go back to like the 80s, right? When we went from, it took a couple decades, but like we started going from defined benefit to defined contribution. If we had like the concept of a personal pension where you could tell the employer, hey, we're going to give your employees the same thing they've been getting, that pension, but it's no longer going to be on your balance sheet. Now an insurer or group of insurers is going to take on that liability risk. And so essentially it's like the pension risk transfer market, but without the kind of like, in the doing it all at once. And so I think like that is the right thing, right? Like an employer match should be for many people, or if not everyone, like through something like annuity, where the employee can't cash out that money and go buy a boat, right? It should be illiquid. It's for retirement. The employer wants it to be for retirement. You should make it for retirement. You should make it all about retirement income. On the employee side, like to get them to contribute, you probably, you do want to allow them to invest in the markets. There's so much upside. You don't want them to be kind of like not taking enough risk, especially earlier in their career. So I do think that it's headed in the right direction. I mentioned Mark Every earlier. He's now at Brookings, and he's written a lot about kind of what's still needed. And I do think there's a lot that's still needed. There's specifically around income annuities, you still really can't put income annuities as part of the default inside of 401k. So I don't think it moves the needle on income annuities. I think it moves the needle on products that do have some liquidity. But going back to what I was saying before, that's not the annuity. I think there's a lot more work to be done.
So, one of the things that you've written about that I thought was very interesting, pardon me, was in a Forbes article about a year and a half ago or so, you wrote about a number of things that you thought that the industry could do to make the process easier. And I know that's something that evolves over time. But I think it's interesting because I think it will be valuable both in the current retail environment, and I think it would also be these same principles that you highlighted would be valuable in the context of having these products in the 401k, if there's any choice that is left to the individual employee. So can you talk about some of the things, I don't know, some of the top things you think that we as an industry could do to kind of get out of our own way to kind of open up the floodgates a bit more on the opportunity here?
I think the biggest thing is it benefits the industry, it benefits everyone in the industry, the more that annuities are thought of as an asset class rather than a bunch of different products from a bunch of different insurers that can be hard to compare one to the other. So, I mean, going back 5 years ago, even, not even that long ago, I mean, I think spreadsheeting was an insurer's worst nightmare. I think now it's very different. And if you want to be inside of a 401k where annuities basically are not in right now, and it should be the largest source of demand, you're going to have to be compared to other providers. And I think that's a really good thing. I don't think that's a scary thing for the carriers. And so I think, a lot of it has to do with if you want to buy into the equity market and you're just getting started, like, what would you guys tell someone to buy? If they say, I want to be, I'm 23, I want to be risk on, what would you tell them to buy?
I tell them to call up Vanguard and put their money in the total stock market index portfolio and then go get a beer.
Exactly. And then exactly. And
when
so
they get more money, put it in the portfolio, get another beer.
Exactly. I would say the same thing. That could be true of the annuity market as well, especially in the context of a 401k. Like whoever, it's a basket of providers, whoever's, most competitive, maybe you shift a little bit more allocation at any given time towards them. Rate and rating are really the things that matter, and that's about it. And then at the end, you're ready to retire and you have $3,000 a month of income on top of Social Security, and it's spread across 7 providers. And, you didn't even realize like all the steps along the way to build that up. And you were, all along you were contributing 5, 6, 7% of your paycheck to get there. That's where we should be. And I think we have to stay laser focused on getting there. So yeah, a lot of the things we've tried to do in the retail market are, the animating thing for us always is technology, and where technology can do better than kind of what exists today. And that's not everywhere, but where it can do better, that's where we've tried to focus on building. And I think a lot of what we try to do with the personal pension is, okay, like down the road, someone should be able to allocate to this every 2 weeks. It should be across providers. It should be instantaneous in terms of when the order is filled, or at least T+1, T+3 at worst, like in the equity market. That sort of thing is I think where we can get to and should be sooner rather than later.
So I think you hit on two really, really interesting things there. So one is this idea of, what might we see if what indexing did in the equity markets, what it would do here. I've always said that John Bogle, as much as he kind of picked on the active managers, I actually think that he made the stock market a safer place for so many people that the entire industry grew. I think that many people, their gateway was buying a Vanguard index fund, but people can't resist, right, variety, so they go out and they try different things. So I think that's a very important principle. And the other principle is that I think that from my perspective, the issue here is that, like, the really rare thing, where there's limited capacity, in my view, is really around longevity risk. It's the fact that you have these companies that create pools, diversified pools. That in and of itself is a huge value add. And the fact that they're companies that are designed to be here for the next 50 years, so that they'll be around to actually pay you at that given point in time. Like, that is actually the unique thing that the life insurance industry can provide. And there's been a lot of energy spent trying to create shiny objects around other aspects of these products, but that core aspect, if you think industry-wide, I think the way you put it was really great. Like, the industry as a whole probably doesn't have enough capacity for the entire country. So that's the rarest asset, and getting consumers to fully appreciate it as much as they should. That's the challenge. And so that's what I got out of that article that you wrote, is that you really articulated a lot of very interesting things that would make it make the opportunity more accessible to the end user.
Yeah, and I think your point about Vanguard is really interesting. Like, everyone always talks about Vanguard made investing better for individuals, better for retail investors, which it did, right? But it also grew the pie enormously, right? And so finance industry, since the onset of Vanguard, the finance industry hasn't shrunk. It's grown, right? So like, I think and you're right, that, like, people are always going to be looking for a little bit of extra. Like, in the equity markets, they're going to look for something with a little bit of leverage, or they're going to look for derivatives, or call options, like whatever. And that's fine. That's great. But I think the plain vanilla thing, that being able to offer that benefits the industry enormously. And then on the topic of longevity risk, I think you're right, and I think that it's not economic enough for the life insurers to really want to assume longevity risk in droves. And so I think, from, like, we were talking a little bit about the Secure Act, I think from a legislative perspective, and this is a pipe dream right now, but I think 20 years, 30 years from now, we'll be talking about how can we add incentive for life insurers to take on more longevity risk than they are today. Because I think the incentive structure for the life insurers is a little bit upside down from what we probably want from a policy perspective.
Yeah. So just to sharpen the question and sort of the audience a little more. So Matt, you're now, guess what? You're now running Carey. You're responsible for annuity development and distribution. I think from what you just said, step one is, hey, you're going to make sure the whole company's API'd. So, quotes, transparency. The company's about transparency, number one. Number two, it sounds like it would be get the machine to run faster. We're like on a monthly, this whole industry is wired for like a monthly batch cycle. It's it's the strangest thing, like 30 days. Like, what? I don't know how we got there, but it is. You're saying let's go to daily, hourly batch cycles. What would be the other, if you had your 5-point agenda, for Carey, what would it look like?
Yeah, I think the first one is look closely at where where technology can do better than humans. And I think specifically things like policy administration, things like, beneficiary changes or ownership changes on in-force policies, things like suitability, right? Like there's going to be humans involved in all of these things, right? Like robots don't run Google, humans do. But the relative spend on technology to humans is still way off in this
Yeah.
and I think like the way I think about it is, insurance is, in terms of like major sectors of the economy, it's probably the one that adopted technology last. And P&C was a little bit faster than life and annuities, and life has been faster than annuities, right? So this is sort of like maybe, and I don't want to minimize the great things that are happening, and people who are bringing technology, like it's happening, like, and lots of people are doing it and approaching the problem in different ways, and lots of carriers have made massive strides. But in terms of like, we still have way more work to do. I think everyone needs to look in the mirror and say that, right? Like there's no underwriting here, unlike in life. Like why aren't we issuing policies in a day? Like that's what we did with the partnership with Pacific Life with the personal pension. Like we're issuing policies same day or next day. Like that is possible, very achievable for all policies across the board, right? Like, and why are we having to call in or fax something to make a beneficiary change? Like where's the web portal to be able to do that? Why, for example, do very few insurers pipe account data through, the Orions and Tamaracks of the world, right? Like, so, that's just like a very low hanging fruit, basic thing that like we need to be doing. So I you asked for 5 things. I think there's probably a list of like very easy technology things that just bring this industry, like, frankly, into the 21st century. That I think would consume, quite a bit of time before you even get to like really risky, really more like bleeding edge type stuff that maybe I would want to do, but conservative insurer wouldn't. Like there's just so much low hanging fruit where you build it, there's going to be an ROI within 6 months, a positive ROI.
Yeah, from like this is great from a product standpoint. Like, okay, so the fixed, MIGA's fixed annuities really well. The income annuities. With transparency, what's the biggest fear? Is okay, spreadsheeted meaning if I'm not, well, I was doing a good business when I was the 5th most competitive, carrier out there. Can I still be number 5 and still win, or do I need to be number 2 or number 3 in the world that you're working right now?
We at no time do we have concentration, like massive concentration in any one carrier, even at times when they're paying a rate that's, maybe 50 basis points or 70 basis points higher than the next best. People think about, some people think about rating, some people think about brand of the insurer, some people think about rate, each of those 3 variables in isolation. And then most people think about sort of all the trade-offs between them, want to understand the customer service. There's so many different ways to
Right.
differentiate. And I think you have to be living under a rock to think that you're not living in a competitive market, right? Yeah. And like that is just not a tenable. I would argue that it's not a tenable position going forward. Like how many, whether or not it's the right way to think about it from a moral perspective, like how many people are you going to find who are going to say, okay, great, like, yeah, I'll buy that product, the one product you've shown me, and I don't need to think about like what else is out there. I mean, a lot of our business is folks who want to educate themselves, see what's out there. So by the time, but many people don't buy through us because they don't like the idea of non-face-to-face. But by the time they get to an agent in their local area, like they are pretty smart. They see the whole market. They know what's out there, and they're going to go with something that is competitive. So, I think there's plenty of money to be made in every other financial market and every other industry. Lots of people are making money despite the fact that people like that the end client is looking around at all the different options and they're going in eyes wide open.
I want to freeze frame something you said a moment ago because it was very interesting. You said that a lot of people come to your site, they get educated, but they still want to talk to a human, right? And so they go out and they go to an agent. And when they go to that agent, presumably they come educated and they know what they want to buy and they want to know from what carrier. I think that is actually one of the most important synergies of this side of the business, the innovator side of the business, I think is missed. And the analogy that I think is an interesting one that I sometimes use is just cars. So 25 years ago, when you bought a car, you walked onto a lot and you were flying blind. Now you show up at the lot, you've got the Carfax, you've got the Edmunds, you have the possibility to know as much about the individual vehicle down to the VIN number as the person that's selling it to you. So while maybe there's some loss of information advantage that sometimes in sales can be useful, you end up having people that come in, like if somebody comes to you with that kind of information, what do you know? They're ready to do business. So
they're ready to go
higher, right? So there's a trade-off between there's less time spent educating and there's more time spent on like higher quality leads and sales. And that's very interesting. That's a service that you're providing that maybe there are probably lots of agents out there that don't necessarily know you provide that service for them. So that's
you can put my address in the call notes. Agents can send me thank you cards. I don't get any thank you cards now. No, I think that's right. I mean, I think the art of selling, right? The relative balance of power for the agent is a lot better if someone's coming to you rather than you going to someone. So, I think and we are, putting the annuities we offer in a very positive light and making it easy for people to understand it. So I think I don't think in the long run, complexity for complexity's sake wins. I just don't. Some things are inherently complex and, one can do a better job explaining them. But I think, the push to make things make more sense to the people who are going to end up consuming them, I think is a recipe for more business, not less.
Okay, so let me push a little harder because now, Matt, I actually am an agent, believe it or not, so I can chat with people online, actually here to talk to customers coming into our site. Okay, I'm an agent sitting here. I'm in Westchester, 10573. Okay, is my zip code my zip code is my competitive advantage, right? What do I do in this environment? Do I knock on your door and everybody else's door and get really good at getting leads for people who are not willing to fill out a form online, but they want to sort of feel like they've got somebody in their backyard? What do I do as an agent here over the next, let's say, 3 years?
It's a good question. I think, you will see the advent of more tools and more ability to kind of have a digital storefront for people who are not, who don't have a army of web developers like we do. And I think, I think it's really important that you can satisfy your existing customers. And part of satisfying your existing customers is not having them feel like, oh, wow, like I like this guy or gal, but the technology, like the fact that I can't access any information on my policy, that's really clunky. So I don't know if I'm going to go buy another one, or I don't know if I really feel comfortable telling my friends to go do this, and I think the fallacy is that recommendations come from a relationship. Sometimes they do, but often they come from, I had this great experience end to end. It was so easy. It was very responsive, and the agent is able to focus on like the hard problems. They're able to focus on like actual advice, actually analyzing someone's portfolio, right? Like they're not focusing on contacting the IMO to find out why the policy that the application for is like been sitting there for 2 weeks and why it's NIGO and they never heard about it. Like that's not value add for anyone in the value chain, right? And so I think the advantage that agents have is they have an installed base of customers. And I think if you look at the numbers, like most people like their agent, right? Not everyone likes the insurer, but almost everyone likes the agent. And so now if you can deliver a better experience that's more modern, then all of a sudden like people's kids will come to you, other people will come to you, and your existing customers will buy more. And that's always, the best source of business. And so I think like using your advantage, which is your relationships and the fact that you can meet face to face, taking that, but then leaving it, trying to figure out how to bring technology into the rest of your business, I think is probably a winning recipe. Like, focus on what you do best. Don't do the things you don't do as well or want to do.
Great advice. Ramsey.
All right. Well, I think we covered a lot of stuff. I think we're up against our time limit. Just want to say, thanks for taking the time to join us today, Matt. And there's a lot of opportunity because this is a real problem for this country. Retirement's a real problem for this country. So thank you for what you do. I think that there needs to be more of you and me and Paul and others attacking this problem. And the life insurance industry is at the center of it. And I think one of the things that really came out in a lot of what was said here is that how much this innovation, these innovative ideas will grow the pie and can benefit the industry and benefit agents. Like what you just said in the last 10, 15 minutes, I think really speaks to that. So thank you very much.
Thank you for having me on.
Hey, Matt, thank you. Hey, listen, thanks so much for your time. Good luck. People know where to find you, blueprintincome.com, correct?
That's right.
And I did, congratulations on your recent partnership with AARP. I mean, that's a huge win for your organization. And listen, we hope to have you back on in the near future and hear more about what you're learning and what the future may look like. Okay. Hey, thanks so much. Like us, subscribe us, recommend us. As Matt said, tell your friends. Okay, we're trying to like and delight our listeners as well. And if you go to our website, you can actually sign up to get an email alert when the new episodes come up. Sometimes it's hard to find if you haven't actually subscribed. So thanks so much, Matt, Ramsey. Have a great, we'll talk to you next week.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.